We are absolutely delighted to have Professor Joshua Abor here with us to present an exciting paper. But before I introduce Joshua, let me say that today we are competing with many interests that happen to be going on at the time. Since the morning, we've been at the IMF World Bank annual meetings in Marrakesh, Morocco, and many of our networks are also participating in those meetings. But I hope they can dive in and dive out as the seminar progresses. But also within School of Finance and Management at SOAS, I know there is an activity going on. So maybe also colleagues will be coming in and going out as the seminar progresses. But this is an exceptional seminar because it is dealing with the most topical issues of our time. Climate finance and climate risk, underpinning climate finance is risk number one globally. A couple of years, risk number one was COVID-19, and climate risk was risk number two. Is now back as risk number one. Intra-Africa trade is priority number one on the African continent. And so this paper is about Africa. It deals with one key issue. And thirdly, inclusive growth is indeed a major component of the SDGs, especially for the African continent. So what Joshua is doing now is today is really doing an impossible task of being able to put together these three dimensions of climate finance, international trade, and inclusive growth, and shining a lens on the African continent. And that's why I find this paper particularly attractive. It's also a good sequel from the presentation last week, in the sense that we are still looking for solutions post the global financial crisis. And really, the solutions will have these three elements, really, of the climate finance, international trade, to stabilize economies and inclusive growth. So this is why we are absolutely delighted to have Joshua focusing on these dimensions for us. Now, I need to introduce Joshua formally, but I know that his reputation precedes all, and he doesn't need introduction maybe. But still, I think I should go ahead to be fair to him and the audience and give the introduction. Joshua, I have known Joshua for many years, and possibly going back to when he was a graduate student at Stellenbosch, and right now his share price has gone up, and so has his market value. He's now a professor of finance at University of Ghana Business School. And this is the same institution where he was dean and prepared the University of Ghana Business School into one of the largest business schools in Africa. And so he did a bit of reconstruction and preparing this. As an academic, he's highly prolific, very highly prolific, both in terms of the journal articles he produces and also in terms of the books that he has put together, leading monographs over the last couple of years, highly cited monographs, entrepreneurial finance and small companies, financial markets and institutions, managed banking in Africa, contemporary issues in development finance, the economics of banking and finance, sustainable and responsible investment in developing countries, the economics of oil and gas, sustainability of management. I could go on and go on. The latest one is the changing role of national development banks in Africa. And of course, you will know that Joshua and I and colleagues both at Harvard Business School and Stellenbosch, we are collaborating on a volume to which a good number of people here also are contributing, including Richard, my colleague Richard Alexander here from SFM. And I don't know where Joshua gets the time to do this, but he does exceptionally high quality work, prolific not only in terms of the books, but also in terms of the journal articles, and also in terms of his affiliation, having a large network. He's now the Afrexim Bank, a research fellow at the African Export-Import Bank, Afrexim Bank in Egypt. He's also, of course, an external research fellow of the Center for Global Finance here at SOAS, University of London. Has also had fellowships as a visiting scholar at the International Monetary Fund and other multilateral institutions. And of course, I should not forget to introduce him as a core member and a researcher within the African Economic Research Consortium, the ERC. But I could go on and on introducing Joshua. I think I should give him the opportunity to share with us all the great work that he's been doing in trying to deal with a very complex but yet important topical issue today. Joshua, we want to welcome you. Let's give you a hand of applause to welcome you to start your presentation. Please go ahead.
Thank you very much, Victor, for the opportunity to share a research paper with colleagues on this platform. And thank you, Victor, for your mentoring role in our academic career. The first time I interacted with Victor was when he was with Birmingham. I called him on phone and I was looking for a supervisor for my PhD work. So I called him from Ghana. I said, my potential PhD student be willing to supervise me. Even though I didn't go to Birmingham, but he's shown so much interest in my academic career, mentoring and coaching me in the ARC and other networks. So thank you very much, Victor. We really appreciate your support. So colleagues, let me share my, okay, so this is already shared. All right, so this is a paper we are doing on climate finance, international trade, and inclusive growth in Africa. So basically, trying to understand how climate finance interact with international trade in explaining inclusive growth on the continent. So just by way of outline, I'll do an introduction, talk about the literature, the method we use, and then empirical results, and then try and draw some conclusions. And of course, take a useful comment from you to improve on the paper. Now, to be able to accelerate economic recovery and of course build financial resilience on the continent, scholars and policy makers beginning to debate the importance of climate finance and trade in designing sustainable inclusive growth solutions. The supply or the provision of finance to developing economies to facilitate trade, to achieve climate objectives, and of course, the global SDGs has become a major issue, and which makes climate finance and trade a very important subject to investigate or to examine. Previous studies have actually examined climate finance from different points of view. Some studies have looked at the effects of climate finance on economic risk. Others have also looked at environmental and economic performance to recipient countries. Other studies have also looked at the effects of climate finance on inclusive growth. And then others have also looked at how trade explains growth, but these are separate studies. Some of the studies really support the trade-led growth hypothesis. In fact, many of these studies have argued that trade or international trade positively influence growth. However, some of these studies reveal a heterogeneous impact of trade on growth because of the extent of trade openness and the different proxies of trade development. The issue then is the existence of the heterogeneous impact consistent across Africa? And what role does climate finance play in this trade-led growth hypothesis? Even though some studies have been carried out on how climate finance would work in filling the finance growth gap, using trade as a moderating variable is yet to be investigated. And we believe that for the African trade system beginning to accommodate or embrace the whole concept of climate finance and to achieve climate objectives and also create enabling an environment for inclusive growth, we think it will be useful to really provide some empirical basis for this. And therefore, this study is positioned to achieve that. So there are three main objectives that we seek to achieve. First of all, we look at how climate finance explain trade. And I will also examine how climate finance and trade independently explain growth, inclusive growth. And then thirdly, we look at how climate finance interact with trade to be able to explain inclusive growth, or in other words, look at the interaction effect of climate finance and international trade on inclusive growth. Just by way of literature briefly, an important debate in international trade literature has to do with the fact that lack of trade finance may be one of the main reasons for declining global trade. Others have also argued that really declining global trade will lead to lower demand in trade finance. The extant literature really has shown the effect of trade on the level of financial openness. And Clark, for instance, argues that changes in trade flows are the most important driver of changes in trade finance. So, of course, we know that finance and trade really have a very close relationship. But looking specifically at climate finance and trade, Bandering examined the effectiveness of various policies for securing climate finance and actually identified that feed-in tariffs, tax credit, loan guarantees, and national development banks, and to some extent, development banks in general, are very useful in securing climate finance. Roman et al. Also explain how climate finance has become the subject of extensive literature. And they indicate that developed countries have agreed to transfer to developing countries at least 100 billion USD annually, starting in 2020. as part of recent international climate negotiations. However, the inclusive growth effect of climate finance and the contribution of international trade to its distribution is yet to be investigated. Now, in terms of trade and growth, I mentioned the trade growth hypothesis. And the issue here is expansion by way of exports, okay, or expanding the economy through exports certainly should bring about increase or improvement in your growth numbers. Because if a country exports, of course, it should be able to expand its economy and therefore record higher growth numbers. Now, trade certainly will stimulate economic growth through financial openness and then domestic output because of efficient allocation of resources, and there's a position by many scholars. Now, though previous studies, if you like, have been able to establish the positive effect of trade on growth, the issue is, do the gains from trade, okay, between countries with different levels of trade, policies, levels of capital really promote growth? And trade openness has been identified to, of course, positively affect growth, while it reduces growth when a domestic market is restrictive by output demand. And this certainly has led to the position of the trade growth nexus being inconclusive, even though majority supports the fact that trade can drive growth. Now, with respect to climate finance and growth, previous studies have established the role that climate finance plays in mitigating climate change and, of course, supporting economic growth. Now, many of these studies establish that climate finance can bring about reduction in CO2, support growth enhancing activities, and of course, will be a very important determinant in growth. International financing patterns are changing as global climate ecosystem has become more complex, forcing developing countries to diversify their funding sources, okay, for climate change initiatives, and of course incorporating these in their national development plans and strategies, okay, because of the recognition of the fact that climate finance can play a very important role in driving growth, of course, development in many economies. So putting all these together, trade may have either a positive or negative effect on growth due to the nature of a country's trade environment and, of course, the level of its resources. International trade will have varying effects on inclusive growth, while climate finance provides an important channel to be able to propel such growth. So if we notice that trade is not really driving growth in the direction that we want to see, then interacted with climate finance, the thinking is that can bring about a positive effect on growth. So we'll try to see what empirical results say. Okay, so on the methodology, we employ a panel data set spanning a period 2004 and 2022 across 54 African countries. We employ dynamic system GMM. So first of all, we look at how climate finance affects international trade. So outcome variable being trade, and of course, lack of trade, previous year's trade numbers, climate finance, and then of course we control for the standard determinants of international trade. Also, to look into the independent effects and the interaction effects of climate finance and trade on inclusive growth, we follow the approach of Zhao et al. In 2022 by utilizing the GMM estimator. So here, we first of all look at the independent effect of climate finance and trade on growth. Then the last model then tries to interact international trade and climate finance in ascertaining the effects of the interaction term on inclusive growth. All right, so to be able to interpret the interaction effects in our third equation, we include the level of international trade, and this indicates, of course, trade here is used as the channel through which climate finance can impact inclusive growth. So based on the equation, the effect of a change in climate finance on inclusive growth is given as follows. So I don't know whether you can see this, but these are variables of interest.
So, yes, we can. Yeah,
okay,
we can.
So
thanks. Yeah.
So with the intra-African, so international trade is defined in terms of two sub-variables, if you like. So first of all, we look at intra-African trade, which takes the log of the volume of imports and exports, okay, amongst African countries. Then we also look at trade openness, okay, which is a standard definition of international trade, which is import and export scaled by GDP. Okay, so import and export with the rest of the world scaled by GDP. Then climate finance. Here we take the UN framework convention on climate change, and that basically talks about local, national, and transnational financing drawn from public, private, and other sources. Okay, so we take the log of climate development finance grant in millions of US dollars. And of course, inclusive growth, we use the Asian Development Bank measure, which is of course weights and scores of different indicators. Then of course the other variables, mainly from the WDI measures. So I wouldn't bore you going through all that, but the main variables of interest are those I've just explained. All right. So for our results, we note that climate finance exhibits a negative relationship with intra-African trade, but has a positive relationship with trade openness. The other variables, control variables, really show expected signs. We see financial development. I think there was a presentation at this seminar some time ago looking at financial development and trade. And so we see a positive effect of financial development on trade, which is, of course, quite consistent with existing literature. Now, we then look at the independent effects of trade and climate finance on inclusive growth. So we see here that intra-African trade exhibits a positive relationship with inclusive growth, whereas trade openness shows a negative sign. We also observe that climate finance here, across various models here, exhibits positive relationship with inclusive growth. Right, and the other variables, control variables, pretty much exhibit expected signs. Then, in terms of the interaction effects, we observe here that climate finance interacted with trade, either intra-African trade or trade openness. Both show positive effects on inclusive growth. And that's quite interesting. And that's a point made earlier in the literature, that even though trade openness may exhibit a negative sign or a negative effect on growth, when interacting with climate finance, we can observe a positive effect on inclusive growth. So, by way of a summary, we find that climate finance has a negative effect on intra-African trade, as shown in our first model. And that suggests that climate finance reduces intra-African trade activities amongst African countries. One possible explanation could be that climate finance enter the host country and may not really be directed towards promoting intra-African trade activities, but could be used to support other key sectors of the economy, and therefore may not immediately see that impacting positively on trade or intra-African trade. However, we observe a positive effect of climate finance on trade openness. And the thinking here is that countries that receive climate finance tend to have adaptive mechanisms to be able to support climate change and of course gain competitive advantage in participating in global trade. Because here you're looking at trade with the rest of the world. We also note that intra-African trade has a positive effect on inclusive growth, and that seems to suggest that increasing the level of intra-African trade activities should boost the level of inclusive growth. However, trade openness, we note that was negatively or had a negative effect or negative influence on inclusive growth. Now, the positive effect of intra-African trade on inclusive growth, we see from our third model, that is enhanced when we bring in climate finance. So climate finance coming into the host country should be able to cause a positive effect between that and intra-African trade on growth. And we see that the overall marginal effect of trade openness on inclusive growth tends to be positive. Okay, so it moves, changes from negative to positive, and when we interact with climate finance. So we argue that countries that receive climate finance are able to mitigate climate change in order to induce a less restrictive effect on trade openness on growth, or for trade openness on growth. So I'll conclude by mentioning that, yes, we've looked at the effect of climate finance and international trade on inclusive growth. We observe three main findings. First of all, while climate finance is negatively related to intra-African trade, there seems to be a stable positive effect between climate finance and trade openness on the continent. Secondly, we note that intra-African trade has a positive effect on inclusive growth, while trade openness has a negative effect on growth. The third finding is that climate finance plays a very useful role in moderating the relationship between trade environment and inclusive growth. In fact, we see that the positive impact of intra-African trade on growth is enhanced when we are able to bring in climate finance into the host country. But we saw that the negative impact of trade openness on inclusive growth is rather minimized at the increasing level of climate finance. So we provide some initial recommendations. We think there's the need to support policies that maximize available resources by leveraging climate finance to be able to drive intra-African trade. We also think that it's important for climate finance and trade policies to work in tandem to be able to maximize the opportunities for adaptation that can produce a greater or enhance inclusive growth. And then lastly, we believe that there's a need to allocate resources through climate finance development projects to be able to enhance inclusive trade policies and encourage investment into trade ecosystems to be able to drive inclusive growth on the continent. Thank you very much.
Thank you so much, Joshua. Let's give a hand of applause to you for this very interesting paper, and also expressing very clear presentation and there are many things I like about your paper. Of course, as I mentioned at the start, it has a very high degree of traction on the important issues of the day. Climate finance and climate risk number one globally, intra-African trade, opportunity number one within Africa, and inclusive growth, a big agenda. And the way you brought them together is very, very helpful. Building on a lot of very recent and useful literature. I could see some of the names right in the audience, some of their papers featuring in the literature review. So, thanks very much. And then I think you are using, I think, the highest, or should say the biggest database to my mind, because you have panel data observations on 54 African countries. I think that's the largest set of data covering so many countries I have noted since, normally the maximum you could do is 55, and some of them, of course, I know some of them are fragile states. So getting 54 is a big achievement, but also for a long period of time, spanning about 20 years from 2004 to 2022. So your data set is really comprehensive, of course, as a panel. Now, maybe we're going to get a chance for some of the discussion, and I have posted some points in the chat, but these are some of the some of the questions at the back of my mind. I think, yes, we could develop a tractable theory that links trade, climate finance, and growth, because you have like a causality leading from finance to trade and vice versa, from climate finance to trade, and from trade to growth, and from climate finance to growth. So basically, you have like a triangulation. If you could put a triangle, it's like a triangulation. The theory that would be pinning this is, of course, in terms of the transaction costs growth, and of course trade is very important in any growth model. So you have a triangulation that has trade, climate, and growth in each of the three apex, and maybe a number of theoretical explanations could be given to actually link the flow and try to understand the basis of interpreting the results. I also see that you have all the three main equations. They appear to me that actually one could do it as a simultaneous equation model, in which you have three equations, and then the interactions are able to absorb potential and heterogeneity problems. But I suppose the estimation here is equation by equation, but I think in a robustness measure, in a robustness test of these findings, one could try to see whether the simultaneous equation system works better. Also allows us to impose restrictions on some of the coefficients and see impose some parameter restrictions and see how the results pan out. And I also liked the explanation of the measures, that table. Although you spent a little bit of time on that table, it had very rich measurement insights. I started thinking maybe I could change the measure of intra-Africa trade, say by using even a standard gravity model, in which when you are dealing with the gravity model, it becomes here because in a gravity model, you are relating the natural logarithm of the monetary value of trade between two countries, say between Ghana and Nigeria, and you are rating that to the log of the respective GDP. So this composite term you generate, that measure, will be able to give you barriers, incentives that exist between two countries. And I think that could be able to, it's a credible measure of intra-African trade. Maybe we would like to see whether this, to find out whether this changes the results at all. Maybe the results don't change, but at least what happens is that we are building robustness to say the results are the same respective of the many way you measure the variables. Very interesting work. Has a lot of points to discuss. The conclusions are very plausible, very interesting. I think policymakers or Afrexim Bank will see how to create incentives for intra-African trade, how to absorb much more of climate finance and boost growth. So very interesting findings also for the bank. Now, what I will do now is go around and attract a call for reactions and questions. Let me see who has the hand up. Oh, yes. Okay. So we have number one, Isof, and second, Hongbo. So we start with you, Isof.
Yeah, okay. Thank you very much, Victor. Let me just put my camera. Okay, I just arrived in the office.
Good to see you. Yes, yeah.
Okay, thank you very much. Hey, Joshua, I hope you are doing well. Thank you very much for this presentation. This is, a really very, very nice topic for many, many reasons, basically, right? And because you are touching on many, many aspects which are very important these days, for the African economies and the development, like the climate finance to mitigate, the climate risk. You're touching also on this trade, which is very, very important. We are more and more talking about being able to boost actually intra-African trades. And of course, inclusive growth, which is the ultimate result of all this actually. I just have a few, comments because basically I know this is a work in progress, and then probably you are expecting us to make some comments on the way forward. Basically, I think, I agree with one of the comments, of Victor, and I'm coming back to that on the conceptualization of all this. I know, you gave us, some literature review at the beginning. I was driving, but I you talk about, what the literature says in theory and so on. I think it will be good also to push that even further. Why I'm saying that? Because basically, I'm curious to see the climate finance actually, through which channels actually is playing. Is it through the financing channel or through the risk mitigation channel? Because these are not exactly the same, right, basically. Because if climate finance is coming as another additional financing, probably it's through the financing channel. Then you need really to use this finance, in literature actually to justify it, and then to tell us what climate finance is bringing as specific, actually. Is it just another addition in terms of finance, or climate finance is bringing something additional which actually justify why we should really dig into that? That's the first thing. The other, conceptual channels you should look at is basically climate finance can be seen as one of the mitigation tools, actually, because basically when you have all this climate shock and so on, one way to mitigate that is through climate finance, actually, basically. Then this also can be another channel, because we can add that climate risk actually will have an impact actually on the activities which actually can affect trade and so on, right? Basically climate finance can come as a mitigation tool for that. Then conceptualization will be very interesting to let us know exactly how climate finance actually comes into play into all this actually from what we know. That's my first point here, basically. My one small thing, probably you have it in the paper, but I'm curious to see the size of the climate financing, the total financing, basically, right? Probably you have that in terms of statistics or so on. Is that real big enough, or is just marginal? Because I know it's climate is important, right? But is climate financing right now a very important part of the financing? That will be interesting, to show it in the descriptive statistic. And my last point will be basically when I look at your result and the simulation, actually, basically, I can see that the development finance has a very, very positive, impact. It looks like it has a significant and positive impact. But at the same time, I will think of climate finance being part of that measure as well, right? Then how do you disentangle that? Maybe because of climate finance, development finance is having a very, positive or significant positive impact. Maybe that's one is taking away some of the impact of the climate finance. I don't know. But I will, look at that, very carefully. And then just a general thing. Of course, in all this study, we are always talking about heterogeneity. Then I'm coming back to that, right? I know you are using dynamic system GMM, but basically, looks like, there are some really serious indigeneity issues, right? How do you, plan to control for those indigeneity issues? I think this is something, you should also look at carefully. Other than that, that's all really, this is really, very promising, work, as I said, because of the topics and so, and then you are touching really on things. We don't have so many research on that, and we need really to research on that to be able really to make recommendations, to be able, to guide actually policies in Africa, actually, right? Okay, congratulations for that. Okay, Victor, I will stop here. Thank you very much for the opportunity.
Thank you, Yusuf, for your very high quality comments and contributions to the paper. I think you cut across quite a number of points, considerations, both on the theory and suggestions also on the methodology. I think in terms of extensions of parts of the paper for robustness testing, quite a good number of constructive ideas. So thanks indeed, Yusuf. So let me now call upon my colleague, and who is also the Deputy Director of the Center for Global Finance here at SOAS, Hong.
Yeah, hi. Thank you very much, Victor. And thanks for the presentation. I think this is probably a very concise, a very clear presentation and the paper. I actually, because Yusuf has already asked a lot of questions. So basically, I have something in common, and that is the channels. So through which channels does this climate finance work on trade and the growth? So because if we are not clear about those channels, then it is very difficult to distinguish between the existing literature, i.e. the financial development and growth literature or trade literature, and trade and growth literature, etc., etc. So we need to know the differences between climate finance and finance literature or finance growth literature in general. So that's basically my comment. If we make channels or mechanism clearer, for example, it goes through the climate channel rather than the finance channel. So we need to know that part to be able to see the differences between this paper and the existing literature. That's my comment.
Thanks very much, Hong, for those important observations. In fact, I think the identification of the channels or even developing hypotheses for various channels would be a great help. ISOF also actually hinted on this, contributed a lot on this by pointing out that there could be a financing channel, in which case we know there is a finance channel from finance to growth. Okay. And so the various studies that exist, which Joshua has reviewed very well, shows how a finance can lead to a growth. That's the financing channel. But how about the mitigation channel for climate change? So those channels could be easily identified. And once they do, it would be relatively straightforward to interpret the results because the channels work. There is also, I think, something that is very important in what you are saying, Hong. There is also something about when you say transmission channels, that there could have been one could have used the interaction terms. The interaction terms could have shown, under which conditions, for example, is it a combination of a finance plus a component, or is it finance and trade jointly driving growth? So the interaction terms could be used. There could be a straightforward a robustness table, maybe table number 10 in this case, in which there could be playing around with the robustness. Because there is something actually I like about the paper is where you are exploring the lags, and find that, for example, I think in the first table of results, we find that intra-African trade or trade does not drive a growth, but the lagged variable drives the growth, and that's what would be expected. It is a trade at T-1 that will affect growth at time T. So the lags dimension also could be explored. I think we could get wonderful stories from exploring those lags, and the channels remain very important also for guiding policymakers. So thank you. Okay, let me see if there is any new information in the chat. I think there was a comment from Richard. I don't know whether he's here around or is possibly he was supposed to go teaching.
Briefly,
okay.
I've got a couple of minutes, but we can continue on LinkedIn if necessary. Okay. So yes.
Do you want to ask, or shall I read the comment?
Okay. I'll ask briefly.
Yeah.
And I wonder, you linked to Hong's question about the channels.
Yes.
I think an interesting question could potentially be the climate finance that comes into African countries. Where does it come from? If it largely comes from the West, or indeed from China or other non-African sources, and of course the West, Saudi Arabia, China all have strong green agendas, could that explain why it enhances trade openness but reduces intra-African trade? And then a follow-up question for us to discuss on LinkedIn is the fact that you discovered that climate finance enhances trade openness but reduces intra-African trade. Does that raise wider questions about trade openness and intra-African trade pulling in different directions? But I need to go and teach now, but Joshua, it would be great to continue this discussion on LinkedIn or by email.
Thanks, Richard. Absolutely gold standard comment. Thank you. Yes, I think Richard has put his finger on in potential interesting interpretation of the pool between trade openness and the growth in intra-African trade. We know intra-African trade has been a challenge for many years. I think I have another paper done with the colleagues at the FDB using a gravity model of intra-African trade. And it's a very small component, especially since we are looking at Africa. In North Africa, it's about 5%. And yet the openness is higher. Even when openness increases, intra-African trade does not increase by parcel. So yes, there is quite some challenge there. I guess that this work is going to open quite a very large number of important dimensions of interpreting the numbers of what we get between trade openness and intra-African trade. So yes, Richard left the comments in the chat, and that was very, very useful. Okay. Let me see if there are any further comments. Let me look again at the chat. Any hand up, comments. Let me see whether I can see everybody. Yeah. No, I don't see any more comments. But we didn't give a chance to you, Joshua, to respond to any of these questions. Maybe we'll give you a chance to respond. Because the questions, Joshua, the questions came in terms of a conversation. One question was leading to another. I didn't want to interrupt the flow of the conversation, but you can come in and then we can start another round of conversation.
Okay. No, so this essentially a comment on improving on the quality of the paper. So we've taken them in good faith. We will reflect in the revision. With respect to the point about development finance, the variable there is rather financial development. So even though, to some extent, climate finance can impact on financial development, we use the IMF index, which was banking sector development, stock market development, banking stability, all the components together in constructing an index. So it may be difficult to really tell which component will be coming from climate finance. But climate finance would impact directly on development finance as opposed to financial development in general. Yeah, but other than that, yeah, the comments are very useful, and we will incorporate them in our revision. Thank you.
Yeah, thank you. So for climate finance, did you get an independent measure that you use in terms of, for example, a climate finance receipts or received by countries in a number of years? I think that data may not possibly go to 2004. But I think for the last 10 years, countries have been receiving this type of finance, especially for mitigation.
Yes, it's mainly during that period. It's during that period. It doesn't go back to 2004. And it just take the receipts. So we take a log. We actually took a log of the actual receipts for each country.
Okay, excellent, excellent. And how about the measure of intra-Africa trade?
Okay, so we use the log of total output and input, but I hear you on probably using a similar measure as a trade openness. We tried that, just that the results weren't looking good. And so we tried this other measure, which gave us interesting results. But we'll look at it again, given that there are a number of comments we need to reflect. So I'm sure that may change a couple of things.
Yeah, thanks for that. Because there are some of the challenges we get specifically with the African data on say using a gravity model, effectively doing pairwise. You take one country, say Ghana, and then you are looking at its trade flows between Ghana and each of the other 53 countries of Africa. Okay. And then you take each country and you are looking at the trade flows between that country and the other African countries. That's number one. So you do pairwise, and you get a huge number of configurations. That always has been the daunting, huge amount of work to be done on looking at bilateral trade in Africa, intra-African trade in Africa. The same problem comes up in measuring investment flows between two African countries. And again, you build a huge spreadsheet, okay, and still you are trying to see to eliminate a possible omission that you exhaust all the players. Investment is much easier than trade, because with investment you find some of the countries in which there are no investment flows between any or two countries. Maybe there is no investment flow between Chad and South Africa, maybe, and that becomes here. But for trade, yeah. So I know it's a huge amount of work. Yeah.
Actually, that data has been constructed by the Afrasian Bank. Because I'm within, I was fortunate to get that data from Dr. Coleman. So yes, so they constructed that for all African countries. So every African country has import and export with the rest of Africa. So there's a huge spreadsheet with that information. So if you look at the table I projected, the data source for that is Afrasian Bank. And then the rest are from either WDI or World Bank.
Well, that's very helpful to know, and I'm sure that the other researchers here in this meeting, this seminar, will try to reach out for that data, especially if it is available on the public domain. Because when we tried to construct it with a couple of colleagues years back, we had that challenge of huge spreadsheets that we're trying to look at. There is a database called Direction of Trade, DOT, and that's where we are working on Direction of Trade. taking paywall scan. But it seems Afrexim Bank has done the work, has made the work much easier by doing that bilateral trade within African countries. Absolutely helpful type of data. So we learned something, very useful, at least for me, learning that Afrexim Bank has that database that we could use. Thank you very much. Okay. Further observations, questions. Yeah. No, there seems to be a. Hong, I can see you. You are unmuted. You wanted to say something? Sorry, no, that's Bojo. Professor Bojo, active member of Group C. Thank you. Yeah, you are welcome if you would like to.
No, I'm not inside. I don't know if you can hear me.
Yes, I can hear you very well.
Good. Yeah, no, I have nothing to say. This is an interesting
okay.
research topic, really.
Okay, thanks very much. Thank you. Thank you very much. Yeah, okay. Okay. Questions, comments? Okay, good. Okay, so what remains for me now is to thank Josh, Professor Joshua Abor, I abbreviate this to Josh, just his name, for an excellent paper. Thank you for sharing with us this work in progress. I'm sure that the comments you received from this group will inform your thinking about the paper. I don't know when the paper will be ready, but yeah, you do have a working paper series within Afrexim Bank, I think. Yeah. So we possibly will see the paper through the Afrexim Bank working series or through the CGF working series, whichever way you decided to share the work with us. But it's been excellent work. It makes us also start to think seriously about the three dimensions of the paper: the climate finance, intra-African trade, in particular, rather than open intra-African trade, and this SDG of inclusive growth, on the African continent. Thank you very much. May I ask let's all bring our hands together and give a hand of applause to you, Joshua, for this interesting paper. Thank you indeed. Thank you.
Thank you.